one of the very sophisticated techniques in finance that we use. You're recording it?
Yeah.
Okay. And there is a reason why we do this analysis, because if you look at the session we had last week, and we ended up getting a value called 3.82. It was €3.82, the fair value of Valmet price. Is it so? If you look at the first spreadsheet, we concluded at 3.82, the theoretical price of Valmet stock. Now, to move further, in order to apply a Monte Carlo model, we need to first investigate what are the shortcomings of the Gordon growth model. Yeah.
Valmet valuation, Excel sheet.
If you look at this Valmet valuation first sheet, we concluded at the end of our finding was that Valmet's stock price is 3.82 something. Was it so? Or was it different? I'm not sure about it, honestly. But that's not that is not a problem. That is not a problem. The point here is that this value, 3.82, I took 3.82, you can take something else. Different companies, different values. Whatever is the book value, which you found, what was the theoretical value you found at the end of the first spreadsheet, that value should come here first. Okay. I can change it. I don't know I have to check what was the enterprise value. If you want, I can do it. No big deal. I have to open then Valmet first sheet. Included the Valmet price was, yeah, it was I mean, about 35, 36 euros, something like that. I can take 35, 36, no big deal. Okay, no problem. So that price was the equity value. The problem with that value, problem with the Gordon growth model that we have is that if you look at the spreadsheet one, which I shared with you before, you see that here we have discrete numbers. If the growth rate is 1%, there is a 44%. There is a 44 euros price. If the growth rate is 2%, it's 59. So what we have like we are pinpointing something. For example, it looks like we have a dot for dot. But life doesn't go like this. There's a lot of things between 1% and 2%. There are a lot of things between 0% and 1%. So life is continuous. You see my point? Discrete and continuous. So before you learn Monte Carlo model, you should be very clear what is the difference between discrete and continuous. Discrete is at a point of time, something at a point of time. Now, what is time now? It is 27 past 13. Discrete. Continuous is that we measure it over a flow of time. You see my point? So the flow of time, I want to give you some more examples of the point of time or the flow of time. I met you today. Now it's at a point of time, but I know you for the last 2 years. That's a flow of time. So I was knowing you even the day I didn't meet you. You see my point? I didn't forget you the day. I don't remember you only when I meet you. I remember you even when we don't meet. But we meet at a point of time. But we know each other over a flow of time. Flow means continuity. Right? So that limitation, the reality of life is the flow of time. If you see the stock market opens at 10 o'clock in the morning, it's a point of time. But the stock market closes at 4 p.m. That is also a point of time. But in between, there are many hours, many minutes, many seconds, and many microseconds when the stock price can go up and down. That is called continuity. Huh? Yeah. So that the continuity part is not taken into account by the Gordon growth model. We know that there is a stock price, dividend value, then there is a rate of growth of dividend, and then there is a the CAPM determined cost of equity. We put the values and we get one theoretical value. Life doesn't go like this. Life is more than that. Okay. So to overcome this limitation, we have this Monte Carlo model. Now, to calculate the Monte Carlo model, I would urge you that you open a blank spreadsheet and we all do together. Okay. It's not that you do it afterwards. What you do is you open a blank spreadsheet, all of you, including yourself. All of you open a blank spreadsheet. Huh? Oh, all right. Okay. Makes sense. Yeah. Sorry. Not right. Yeah. Open a blank spreadsheet, all of you. Write down these three numbers. Revenue growth rate, the first variable. You can copy and paste even from the spreadsheet, which is available in Moodle. So revenue growth rate, you know what is revenue? At the rate at which your sales are increasing, right? Then the operating profit growth rate. Can you shut it down, please? Operating profit growth rate. Yeah, he can knock because you know what? There's office people. I don't want to bother them. There is operating profit growth rate. Yeah. And you know what is operating profit? Operating profit is your total revenue minus the cost of goods sold. The cost of goods sold. And the cost of goods sold includes two costs: the cost of production and the cost of selling the good to so that it reaches to the final customer. Okay. So when you have the total revenue and you subtract the operating your operating cost, what you're left is with operating profit. Operating profit. Okay. Now, at what rate operating profit is growing? So this is not revenue. This is revenue growth rate. Revenue growth rate. Okay. Now you do one thing. For each number, you also make some estimate. Look, in the real life, I don't have to assume that the revenue growth rate is 6%. I can see some companies' annual reports, income statement for maybe 10 years, 13 years, and I can calculate the average growth rate. Okay. But I don't want to do that mechanical thing again. We have done it many times in the past. So I assume that this company, Valmet, the revenue is growing each year at 6%. This is my assumption. Okay. I'm forewarning you, these numbers, which I took the first, second, and third, and even the first, second, and third, these are based on my assumption. But this is not an assumption which you cannot test by yourself. You can. If you spend some time and you go the company's historic data, you can easily find, no big deal. Okay. Now, I assume that this company, Valmet, the revenue is growing at 6% and the operating profit is growing at 14%, and the cost of equity is 6.3%, right? The cost of equity is 6.3%. Believe me, this is not my assumption. I took this number from the previous spreadsheet when we applied CAPM model to calculate the cost of equity of Valmet. If you don't trust me, I can give you evidence. Last time, when we were calculating the actual data-based things, and we found out, oh no, it's 5.021. Well, I can change it now. So the cost of equity that we had was 5.02. You agree with me? Okay, so no big deal. So in this Monte Carlo, I can use the same value because it's 5.2. So it should be 0.52. Okay, 0.52. Yeah, let's call it. Yeah. So, and the cost of equity, the equity that we checked was 36 something approximately. What we measured was 36 value, 36 euros, the cost of the price of the share. I assume that the standard deviation has been 11%, 15%, 12%, and 15% here. Once again, it is not a rocket science to calculate it by yourself as well. If you have the revenue growth for the last 10, 20 years data, you can simply calculate standard deviation. You know how to calculate it? I showed you in the previous spreadsheet. There's a formula. Variation, we call it in simple words, variation or volatility. Make sense? So these are the numbers which I assumed here. All right. Please tell me if you have any question or any issue about the nature of these variables and about the average value and about the standard deviation, which means volatility. If you have any question or doubt, please let me know. It's very important that we are very clear about these things first before we go next. It's a very easy model, very small model, but understanding the reasoning is quite important.
The calculation on those three items, those revenue growth rate. So you'll have done like based on compared some years with each other, and then you find like the revenue in 2023 in comparison to 2022. Then just 2 years or
no, not 2 years, at least 10 years. Yeah, at least 10 years. Because if you have 10 years, only then you can have 9 growth rates.
These are the average rate.
Yeah, then you can find the average growth rate. Or even if you don't want to go in the history, I tell you something, it's not a big deal. Because sometimes the immediate past is more important than the distant past. So therefore, even if you find 1 or 2 years value and you take them, it's fine. But make sure that should be the normal years. By normal years means not lost years, not loss-making years, the normal profit years. Okay, because profit, look, we can say that the profit and loss are the random event in the businesses, but we always expect to have profit. So profit is something which is more an expectation, and loss is something which we assume as something, an exception. Okay, so if, for example, you want to take last 2 years or 1 year and that number come to be negative, that could be not a very good thing, you know. Then our whole negative value basically are not something, you know, which we. So find some positive value. So you can ignore some. If you look at last 5, 6 years, and this company is having 3 years losses, ignore those lost years and only take those 3 or 2 or 1. Here you can play your own choice, you know. So I don't want to, restrict you too much what you do, but take some values, positive values, okay? And then we have the standard deviations, which means volatility. So if you have last 20 years data and you find the mean value of the growth rate is this much, what has been the volatility? What has been the variation? That you can measure with the standard deviation. Make sense? Okay. Now, if you are fine with this matrix, then we move on to something called next column. Always call this as a reference value. Reference value. Here, the reference value is that we want to check the normal distribution value. There is a distribution, I hope you understand, that in finance, in statistics, we have a normal distribution curve. Okay, which basically means that it's a bell-shaped curve. There's a data. Some data, there's an average. Some values are more than average. We call them positive. Some values are less than average. We call them negative. The rationale behind the normal distribution is that if you move some distance here, the frequency of more than average value, if average is 50, let's say this is 50. Let's say you are calculating marks or income or whatever, the average comes to be 50. If you want to check 10 more values, make it 60. And also at the same time, you want to check for 10 less than the average, which means 40. Then 40 and 60 should be having same frequency, that if you match them, they should come straight away in a straight line. It's not here, but in theory, it's like this, that they should be making this exact straight line here. And if you go 20 plus, means 70. And if you go 20 less, which means 30, then they should also be matching. This is called normal distribution. And we want to test that how far the data, these values are, if they were normally distributed, how they would look like, right? We have the real values with the reality, but if they were, and reality is not always normally distributed. Reality is, normal distribution is that if I have 10 students in the class and the average marks are 50, it means that there should be one student who got 60 and there should be one student who got 40. There should be one student who got 70, there's one student who got 30, and so on and so forth. But do we have the marks like this? If we have the reality could be different. Very coincidental that the reality would be same as what theory says. But it could be possible that out of 10 students, there are 3 students who got 30, and there are maybe 6 students who got 50, and there's only one student who got 90 marks. Now, if you draw it, it will not look like a normal distribution curve. It will not look like that. Okay, so it means that the reality could be non-normally distributed, but we want to check that, hey, what if these values were normally distributed? So we want to compare the reality, you see the movement, with the theory. That's the first step. Step number 1, the reference value let us know the theoretical values of the real values.
What would be the result like after doing these things? What would be like the...
Well, you'll see it. Then you have to wait. All right. So what we do, we calculate the reference value. And there's a formula. Don't ask me where this formula come from, because it's not me who made it. It's a formula. It's given by some mathematicians, and I'm not a mathematician. I'm only an user, or how to say it. I'm only applying this formula, okay? But it's a good idea to call it reference. Reference means you're comparing the reality with the reference. Reference means the theory, okay? And see, this is how we go do it. So what you do now, when I ask Tanya to take a pause, you have, remember the formula is called reference value, which means the benchmark. Benchmark means theoretical benchmark coming from normal distribution. And this is the formula.
Thanks.
All right. So the formula is, if you start typing in, if you want, I can do it again. No big deal. Or maybe I do with you. I delete everything and I do all over again. So Yeah, I keep one value so that I remember the formula, but I remove all other values. And I even remove these values, which are here. This I keep. Only the names, but yeah. Anyways, okay. The first value, because I didn't want to get the formula, and I can remove the chart also because it doesn't matter. All right, now I am just like you. We all are equals now, okay? Except that I have one formula which says normal distribution dot inverse. When you type in, you will see a drop down menu. It will show up automatically. So nothing, you don't have to type the whole thingy again. I can do one. Okay, let's do it. If I type in norm slowly, not fast, I find that there is something normal norm.inv. Okay, do this. And then type in random number. And how we type random number? Random number. And then there is a one bracket comes automatically. Can you see one bracket? We don't need it. We shut this bracket. We shut this bracket, okay, by ourselves, and put the sign of semicolon. And semicolon is this sign, okay? Take the mean value. The mean value is this, yeah. Again, take the semicolon and take the standard deviation value. And then don't forget to close the bracket. Okay. Look, we type in norm. There'll be many normal distribution variations. You pick up the norm dot inverse inv. Okay. And then something shows up. Then you select random number. But you know why I close the bracket without typing anything there? Do you have any idea? Because we don't want a random number which could be a million or a billion or and even minus 0.00007. Because here we are dealing with what? The stock price. And what has been the stock price? 36. Can you see 36 here? I want that even if I pick up the random number, they should not go too far away. I mean, how is it possible that some companies whose share is selling at 36 euros today will become 36,000 tomorrow? Is it even realistic? No. I don't know what's the price tomorrow. I don't know what will the price of Valmet tomorrow, but I know that it will not be 36,000 or 1 billion. You see my point? Therefore, I don't want my random number to be too random. So I fix them. I fix them within a range. And the range is their mean value subject to the standard deviation. This is why I have random number. By default, the red bracket shows up, but I say thanks, but no thanks. I shut it down immediately. And then I pick my own range of random numbers. And you see D4 is the mean value, semicolon. E4 is subject to the standard deviation. D4 is the return side, what you gain. And the E4 is the standard deviation, which shows the fluctuation and the risk and volatility. It will definitely not be the same. I mean, no, because they're random numbers, of course. Yeah. That is the whole idea. Why should we want that they should be same? And then we extend this formula. You can type for everyone. Well, there are not many, but even if you do this way and drag it down, these would be the reference values for each of them. These are not the values where I put the dollar sign to fix them. These are the randomness would continue. That is the whole beauty. Okay. You get my point? Very good. It's very important that we all understand at the same time and we all are at the same step. Are you done with the reference values, all of you? Huh? We slightly move to the right. And I call it iteration. What is iteration? Iteration is that you try first time, second time, third time. Remember, what is the beauty of normal distribution curve? That it doesn't come in the breaks. If normal distribution was a discrete distribution, then the bell curve shape would have been like this. And you could have counted 1 value, 2 value, 3 value, 4, 5, 6, 7, and 8. And you could have said that there are only 8 values here. 8 is discrete number. 8 is discrete number. Have you ever seen, I want to give you one more example from the non-financial side. Sometime you go to doctor, right? And the doctor checks the temperature, the blood pressure, and he writes it down that this is the reading of the temperature, the blood pressure, the sugar level, whatever. Is it a point of time or is it a flow of time? Is this measure done by a doctor or at a point of time or a flow of time? At a point of time. If the blood pressure shows 130 when you sit with the doctor, there's no guarantee that when you come home, it will remain 130. But is the doctor with you all the time? Is he measuring all the time? Yeah, that's a discrete measure. The continuous measure is that we have some machine or something with us, which is continuously measuring it. And if we are interested that, hey, I met doctor at 4 p.m. What was my temperature when it was 37 minutes past 1? Or what was my temperature when I was sleeping at 2 a.m.? That is the continuous measure. Yeah. So every time when you check your temperature, you are checking knowingly or the machine is checking by default. That is the iteration. 1 measure, 2 measure, 3 measure. Maybe it can be 1,000 times measures. You're not even aware of it. But the machine is checking it for 1,000, 10,000, 20,000 times a day. That is the continuity. That thing I want to bring here. I don't want to take 1 or 2. Remember, last time we checked, what if the GDP is growing or the economy is growing at 1%? Some number comes, and then we jump. What if the economy is growing at 2%? But here we assume that, what if the economy is growing at 1%, 1.111111%, 1.11112%? You know, that is a continuous measure. That is why what I do here, I can even do this part by myself. I'm basically deleting it. I can type it again. I call it iteration. And let's say, I think that in Excel, there's a default measure that you can check it for 2,000 times. Of course, 2,000 is better than 3 or 4. Yeah. So what I do here. Huh? Okay. What I do, I type in 1, 2. Look, those numbers are changing. Yeah. The randomness is showing up. Don't think it's an error. The randomness is going. Something is going in the planet you're not aware of, but yeah. So maybe I type some values. Now I need 1,000 values. So if I keep typing at this speed, it will not take more than 1 hour. So what I do here, I select them, yeah, and then I drag it down. So instead of checking my stock price, maybe I can make exactly 1,000. Instead of checking my stock price when economy is growing at 1%, then 2%, but that's boring. Here I have, what if this happens? What if that happens? And how many times I'm testing it? 1,000 times. That is a beauty. This continuity is the beauty of oh, 94. No, I think I should be taking more. Yeah, now it works. Yeah. So I have 1,000 iterations. Yeah. You like it? Now, here I write the expected values. Expected stock values or values, whatever. And remember that this is not only applicable in finance, it can be in any. You can even check you can apply even Monte Carlo model to check your academic performance by putting in some marks and checking the standard deviation. Yeah, make sense? Are we all good? The only technical thing you have learned so far is using the formula of normal inverse distribution, right? That's the only technical thing you have done so far, or the complex thing you have done so far. And then you created some 1,000 random numbers around a random iteration, not numbers, but random iteration. 1 iteration, 2 iteration, and 1,000 iteration. Are you all good? Take a deep breath now, because now you want to do something really, really great. Take a deep breath. Just assume that life is very beautiful. There's no problem. Yeah. Now, the first value is the first value which you get here. Okay. Remember the equity value? The equities, after all, you're going to estimate the price of the stock. And what was the stock value? The stock price was, reference value was 36 euros and some 27 cents, right? You can reduce the decimal point, that doesn't matter much, yeah? That is the first value. All good? Now, the step is very important now. I want your full attention. Select this whole thingy and go all the way down. So it means that no more values, only 1,000 values. Go up. Is it fine? Is it looking the same way as you see it? Is it looking the same way? No. Go to data. This thing is bothering me. In the data, my apologies. In the data, there is called something called what if analysis. In the data tab, when you click, do you see what if analysis? All of you? Sarah, look, data. And then there's a what if analysis. Do you see that? All of you. Click this and see data table. So I repeat, select, everything should be gray. When you select it, everything will be gray except the first iteration. And then click data. In data, go to what if. What if has a drop-down menu. And here there is a data table. Click this. It says row input and the column input. It shows row input and column input. I will simply ignore the row input. You know why? Because all my iteration are in the column. I want column to be filled, not row to be filled. You with me? I want column. Which column is this? This expected value, huh? Yeah. So what column? Because I can't see because of this tab is here. Expected value is which column? K. No, only say one. K. Okay. Expected value is K column. Yeah. Huh?
Expected values L.
L column. So I want L column to be filled. Okay. So the now because I moved, so I have to do it all over again. Okay. Now I. The row input, but do one thing. Now this is something very tricky because this is the Excel thing. Before you click something in the cell, click this cursor somewhere, anywhere, just anywhere. So you get here and then just do this number. I mean, just somewhere, anywhere, no problem, but in the blank cell. Yeah, it should be in the blank cell. Are we all good? And then click OK. And guess what? You have the randomized 1,000 values of the stock. But at the same time, they are not far away from the reality. You don't have the millions and the billions here. Because the value is still moving very close to exactly, which is a reality. Because in a very, very, very abnormal circumstances, today the stock price is 100 euros and tomorrow it becomes 0. But that is a super exceptional situation. Now we have 1,000 what ifs. And you don't have to type in by yourself, what if growth rate is 1% growth rate? No, it comes randomly. This is the application of the Monte Carlo model, but it's not complete yet. Like I told you that when you do your dissertation thesis, you would be using the descriptive statistics, right? And in the descriptive statistics, we often find mean, minimum value, the maximum value, and the standard deviation. Okay, that we do now. So if you want to find what is the maximum expected price, so if you're interested, what is the maximum expected price of Valmet, then type in max and use these values. The highest price, highest expected price at the end of, let's say, I don't know which year we took last time. I think we took terminal year 23. The day when we took the final day. I think last week was 20th of September. So our terminal value was 20th of September 2023, right? So it means that the maximum price, the maximum expected price is 36 euros and 61 cent. And then if I simply use it, or I can simply select the data, no problem. Sorry, what has been the numbers? The cell have been moving from L5 to L1004. So this will even save me from so equal to minimum. I can simply type in L4 to L5, sorry, L5 to L1004. And So this has been the minimum price. Remember, minimum expected price.
There are 35. Number 10.
Sorry. This is the whole.
Oh, yeah.
Because the random numbers are also changing. Remember why these values are changing? Because the random numbers also keeps changing. That is the beauty of randomness. I think we are so used to of seeing the fixed values that when we see that these numbers are changing now and then, we are a bit surprised, but that is called randomness. And then the mean value. What is the formula? Average. Average. You can even drag it down or simply type it L5. This high, not a high, what do you call it? There's two dots. Colon. Yeah, because the one with the dot comma is called semicolon. So it's L1004. This is the mean value. And then you can also do the standard deviation. Standard deviation P we take, or even if you take standard deviation, no big deal. Once again, if you want to drag it down, it's your choice. I want to do both ways so that you don't get confused. Huh? Yeah, S is the sample. P we use when we have larger values, but if for some sample values, we take S. So standard deviation, S. And then you select the data, or just type in, or just select the data, no problem. If there's a very big data, then it's easier to just type in. Dragging could take a while, but it doesn't take ages, just a few seconds. Or descriptive statistics. Descriptive statistics is a kind of showcasing how your data looks like, basically. What are the basic features of your data? That is called, it's not analysis. It's not the real deep down analysis, but it's like getting introduced with your, because in the data, you might have 10,000 observations, but you want one representative value. And these are the representative values of the data. Basically, we have applied Monte Carlo model, but we want to, the most beautiful part of Monte Carlo model is how the graph looks like, the graphic. Now we want to see how close these values are to the normal distribution. Okay, and
it's more like normal distribution. It's different, like it's a sign of.
Yeah, you can say that if it is normally distributed, then the standard deviation is 0, basically. Yeah. Then everything is equally. Yeah. Like, for example, if I give you the data, let's say there are 5 observations, 10, 20, 30, 40, and 50. Not 0, but it's the minimum standard deviation. And then you just calculate the standard deviation. It will be the most minimum standard deviation. The least standard deviation would be here. Non-zero, it will not be 0. 0 will be if it all is 10, 10, 10, 10, 10. But this would be if you plot these numbers, 30 would be the average. And this is 30, 40, 50, 20, 10. Very nice bell-shaped curve, right? Okay. Now what I do nothing, basically. I simply select the data, only data, not the text, but the 1,000 expected values. Because these prices look a bit awkward because the values are 5 or 6 decimal points. So if you want, I can do formatting, format cell. number, and we can have only maybe 3 or 4, 3 decimal points, or maybe 2 decimal points we can have, no big deal. Okay, now it looks like a more reasonable, like 35 euros and 71 cents and something like this. Yeah. Okay, all right. Now I select once again. In Excel, we have an insert function. In the insert function, you can have the you can pick up the graphic, the histogram or whatever graphic. I pick this one, yeah. And guess what? All these 1,000 values are plotted. All these 1,000 values are plotted. The data is not normally distributed. The two more measures that we use called skewness and kurtosis. Have you heard skewness and kurtosis? The skewness is, okay, I have to I have to take a pause, and this is somewhat normal distributed. If I plot the graph and I find that the tail of the graph is overly heavier on the right side, does it look like normal distribution now? Does it or not? No. It's called right positively skewed distribution, because most of the values are on the right hand side. Positively skewed distribution. Skewness. There's a phrase called skewness. Skewness. Which means because the data is lying mostly on the right hand side, and the right side would take the positive values, so I can call it positive skewness. Positive skewness. And if I plot the data, it comes out that the right tail is very small, but the bulk of the data is lying on the left tail. You can call it left-tailed skewness, but because it's in the left tail, we can call it that data is negatively skewed. Negatively skewed. Does it make sense? Now tell me something. Now keep these images in your mind. When you see this data, does it look like normal distribution, positively skewed or negatively skewed? So you see that most of the values on the right side. But there's not too much of skewness. There's still not too much of, it's not like too much tilt on the right or too much tilt on the left. Do you agree with me? It means skewness is not a big deal here. The skewness is not a big problem. Do we agree or not? It's not exactly. I know there is a confusion. I'm again sharing this screen. The way our finding look like, it seems that we have the we have the curve like this. Am I right? Let's assume that it's near normally distributed. Is something still very awkward in this curve?
Yes, like in the middle, there is also.
The flatness. The curve is not curvy. I mean, ideally, if it was a normal distribution, it should be like this, like a bell-shaped curve. But here, the bell is bell is like a playground, like a football pitch. It means the bell is not a curve, but a flat stretch. Look, the data is either lying too much on the right side or too much on the left side. That is measured by skewness. If a country is, if we have the absolute evenly distributed income, the income differences are very even, middle, there's a very pattern of the whole population would be under the bell curve. But if you find that there is a per capita income in the middle, the average, but still the larger population of the country is below. Have you ever seen a country whose per capita income is 25,000, let's say 3,000 euros a year, but 90% of the people are above the average and 10% people are below the average? Have you seen this example? So there are very few poor people, but largely people are rich. Have you seen a society like this? What you often worry, what you often debate, that, hey, per capita income is not a good measure of countries' well-being, because even if the per capita income is 20,000, it doesn't show that, it doesn't mean that everybody is getting 20,000 euros exactly at the end of the year. Rather, the worry is that 2%, 3%, maybe 10% of the very rich people would be super rich, but the masses could be very, very poor. Though the average looks very good looking, $20,000 a year is very good per capita income. It means that you are worried that the curve would be too much left-tailed. If you plot the people's income, per capita income, and it looks like a left-tailed curve, which means that the tail, how to say it, where is it? It's like this one. It means that the average income is this in the country, but the bulk of the population, let's say 70%, are on the poorer side, and only 30% people are on the higher side. If this is, then it's evenly distributed. Very well, very nicely, good pattern. But the problem here is not the right tail or left tail. We are struggling with one more problem. The problem is that the distribution looks quite okay, but this part is like this. Okay, then this is called a problem of kurtosis. We have one more statistical measure called kurtosis. Skewness measures what percentage of people are too much on the right side, too much on the left side. Kurtosis is K-U-R-T-O. I'm adding to your vocabulary new words. Kurtosis. Kurtosis, and this is not F, this is R. So let me erase it. Yeah, kurtosis. Kurtosis measure how much is the curve pointy or not pointy? Is the curve pointy here that we have here? Why is the curve pointy here or flat? The flatness shows that how big the flatness shows that how big is a certain society. I mean, if I say that, you know what, in our country, there are people who are in the middle income, above the average, below the average, but in our country, there is middle 35% people who have the highest income. So there is a big stretch of 35% people. That shows the kurtosis. Skewness shows how much how many people are above average and how many people are the left side, but how big is your middle class? How big are the people between 50% and 75% income? How big are the people who are above 75% income? That is measured by the kurtosis, right? So the skewness is the tail, and the kurtosis is how big a certain section of the society in the country is. That is measured by kurtosis. Okay, so it looks that from our calculation that skewness is not a problem, but kurtosis is actually. It means most of the prices are scattered in this range between 35 and 83 cents to, let's say, 35 to 99 cents or something like this. Okay, now what you can do here, if you want to make your graph a bit bigger, why not? And you can even drag it down so that you have more value. So this is how the Monte Carlo model can estimate your iterations, that what could be the expected values of your stock by performing 1,000 iteration. You can try with 2,000 as well. I'm not sure, but I have a hunch that you are allowed to do up to 2,000 iterations. And guess what? Sorry. If your assumptions change, I want to drag it up so that you can see it. Let's say 60. Guess what? The values change. Did you notice that the graph has changed? If you remember that the next year is not very stable, but even more volatile, more standard deviation, the graph would change. If you change some assumptions about your revenue growth rate, if you become certainly pessimistic that your revenue is not growing at 6%, but rather 0.02%, the chart values would change. So this is like you have to build your model once, and then you can play with the numbers and see that in optimism, how the chart would look like, and in the pessimistic situation, how the chart would look like.
Comparing this one with the normal one, and then they decided to good idea.
Yeah.
Okay.
But you don't see the normal. We only see things which are near normal. Near normal. So we have applied two very bombastic models. The Gordon growth model, which is really good. I like the sophistication of Gordon growth model. But the problem with the Gordon growth model is the discrete values. But Monte Carlo model is overcoming this limitation. Monte Carlo model is less conceptual, but it's more how you draw. It's more like a, the data analysis than finance. Okay, so that is everything about Monte Carlo model. If you have any questions, comments, please let me know. I want to give you another example of continuity. That when you go to Yahoo, very often I ask you to go to Yahoo Finance. And you've been very obedient students, you follow me very often. And here, if I type in Valmet, same company we are analyzing, Valmet. And first I stop share and then share again. You can see that it's only one day, and even the day is not over yet. Can you see the variable is discrete or continuous? Okay. Now imagine if I only check the price at 10 o'clock, then at noon or 11 o'clock, then at 12 o'clock, then at 1 o'clock, then at 2 o'clock, then this curve, this shape would have been missing. Then we only have this type of 10 o'clock, 11 o'clock, 12 o'clock, 1 o'clock. And then this curve cannot be formed because we don't know what happens when it was 10, 5 minutes and 11 seconds past 10 o'clock. So the continuity would be missing. But now you can see that this is continuity. This is continuous. And remember, this is not even full day. So you have basically millions of prices in between. And when I say the word millions, I'm referring to iteration. So you have the millions of iterations here. But of course, these iterations are not based on the expected price. These are based on the historic price. This price is not expected. This was reality. Even in the real life, there have been millions of iterations. So therefore, this large number of iterations, we should also keep in mind when we are forecasting the price of a company's stock.
So should we apply these for the inner?
If you have any questions, comments, anything to ask, I'm here for another 10 minutes. You can.